A country smaller than Rhode Island just made its citizens the richest on earth. Not the most productive, not the hardest working, the richest. Luxembourg. Population under 700,000. GDP per capita over $130,000. That's not a typo. That's roughly double the United States. So what's going on here? Did they discover oil? Gold? Some secret mineral under the soil? No. They discovered something far more valuable. Paperwork. Here's why this matters right now. While bigger economies argue about manufacturing jobs and trade deficits, Luxembourg quietly became the second largest investment fund center on the planet. Only the United States holds more fund assets. Not Germany, not France, not Japan, a country you could drive across in under an hour. Let's break down how this actually works. In the 1960s, Luxembourg looked around and realized something uncomfortable. Its steel industry, the backbone of its economy, was dying. So it pivoted hard. It started writing financial laws designed to be more flexible, more private, and more attractive than its neighbors. Banking secrecy came first, then low taxes on holding companies, then a legal structure that let investment funds based in Luxembourg be sold across all of Europe with minimal friction. Think of it like this. If the European Union is a single market, Luxembourg built the customs counter everyone has to walk through, and it made that counter incredibly comfortable. Now here's the uncomfortable math. Much of that GDP per capita number isn't generated by Luxembourgers working harder. It's generated by money passing through. Multinational companies route profits through Luxembourg subsidiaries. Investment funds are domiciled there on paper, even if the actual decisions happen in London or New York. A company can sell a product in France, book the profit through a Luxembourg entity, and pay a fraction of the tax it would owe elsewhere, legally. This is the hype versus reality gap. The hype says Luxembourg is a financial powerhouse built on innovation and efficiency. The reality is closer to this. Luxembourg figured out that countries compete on more than just goods and labor. They compete on rules, and Luxembourg wrote rules other countries couldn't or wouldn't write for themselves. There's a quiet irony here. The wealth isn't hidden in secret vaults. It's hidden in plain sight, inside thousands of corporate filings that most people will never read. But zoom out, and the risks become clear. An economy built this heavily on financial flows is exposed to something most resource-based economies aren't: reputation. If the EU tightens tax rules, if global minimum corporate tax agreements actually get enforced, if just a handful of major funds decide to relocate, the foundation doesn't crack slowly, it can move fast. Luxembourg isn't rich because it makes more. It's rich because for decades it made itself the most convenient address on a piece of paper. So here's the question worth sitting with. If a country's wealth depends on companies choosing to say their money lives there, what happens the day they choose somewhere else?